Hi, this is Jeff Ong. Today I'm going to talk about Singapore property cooling measures. How will this affect aspiring property investors? First, a disclaimer. What happens when you invest in Singapore or a country that restricts investing in multiple residential properties? Say, for example, you have $1 million and you invest in Singapore's resi real estate. With the first property that you buy, the LTV or the loan to value ratio might be 75%, right? The stamp duty, I assume, is about 3.5%, and the average value of a 3-bedroom apartment in Singapore, private apartment, is about 1.4 million. So the deposit plus stamp duty already amounts to about 399,000. That's well and good. You will have about $600,000 left to invest, right? But what happens when you put a second property under your name? The LTV drops to 45%, deposit is 55%, stamp duty for second property is 20.5%, which is due to additional buyer's stamp duty of 17%. So the total cost of second property is 55% deposit, right, plus 20.5% of $1.4 million, okay, which is 75.5% times 1.4 million equals to 1.057 million down payment and taxes for the second property. So definitely you have insufficient funds, okay, to buy two under your name. So don't forget, when the more money you put in, okay, as a deposit and taxes into property, the lower your cash on cash return or your return on investment, which is, right, your capital gains plus your rental income, net rental income divided by the deposit plus taxes, transaction costs that you put in. Now, the effects of the cooling measure has made it worse. Number one, there will be an increase in BTO flat supply from 17,000 in 2021 to 23,000 in 2022. But there will be a high down payment required for HDB loans from 10 to 15%. So there will be more supply, but to buy, you have to put even more higher deposit now. Number two, the prime location housing model. There will be greater interest in flats that are close to those zones, but not within the zone. So you think about Toa Payoh and Bishan. That could be an opportunity, right? Number three, new condos snapped up by HDB upgraders to lock in prices. Well, that will drive up the prices as first-time home buyers keep buying up new condos that haven't been completed yet because they want to lock in that place of theirs. Number four, en bloc fever likely to cool down as the ABSD is now 40% for developers. Okay, the risk is higher, so the developers' appetite to buy will mean that it will be restricted to only projects with 100 units or less. Okay, so the risk is lower, it's easier to sell. They will lower the prices they're willing to pay. Okay, number five, definitely investors in Singapore will be very hard hit. Right, think of 70% ABSD, TDSR being reduced. Okay, it just definitely lowers your ROI, makes Singapore very hard, not attractive anymore as an investment. And that is what I've been saying before. Singapore's very proactive intervention measures to curb property price rise has been very effective. Okay, number six, rental market revival with the VTLs will happen this year. So there's only one good news. I think that 2021, surprisingly, the rental market was very strong, even though the expats were leaving. That was because the local tenants, like millennials who couldn't stand staying with their parents 24/7, decided to rent their own place. Or couples not willing to put up with a long wait for BTOs, decided to move out after they get married. Okay, or HDB upgraders temporarily in between homes willing to rent a place for 6 months to a year. So I think number six, okay, 2022, rental market will be even stronger, and we could see rent rising by 5% to 10% in Singapore. All this is temporary, right? So in Singapore, right, looking at the graph for property prices, timing is the key. You look at 1990, from 1990 to 1996, when there was no government intervention, the rise was incredible. It was close to about 4 times, right? But after that, with repeated interventions and cooling measures and reversing of the cooling measures, property price has been very choppy. Okay, so I would say that timing is key in Singapore to make money. The best time to sell is where there are a series of cooling measures until the property price reaches its peak. Okay, 1 year after the first cooling measure is out, you probably can sell. You probably hit the peak. You can't wait until the peak is gone and it's gone down, because property takes a while to transact and the buyers will go away. So that's for selling strategy. Now, to buy is where you see the first cooling measure being relaxed, right? And that, for example, in 2017, after the property price has fallen by 12%, the first relaxing of SSD measures come up. There was the time to buy because property price, hey, went up by 15%. From then to 2019, there was 2 years, which is close to 7% per year. Now, overall, there's a problem of two in Singapore. Say a couple decouples and they buy two properties, one each, right? Husband and wife. So $2 million of condo each, mortgage of 75% LTV, mortgage of 2% interest per year, 25 years mortgage tenor. And you expect maybe, hopefully 5% capital growth annually. 10 years later, both properties appreciate to $3.26 million each, but the mortgage has been paid down from 1.5 million to 987,000. So you built a fair bit of equity there for both properties. Now, you have two options. One, selling your investment property to clear off the mortgage, sell off your property, on your investment home. And after that, with that spare cash, the proceeds, right, pay down the mortgage of the home that you're living in, right? You still have $1.28 million of cash to live on for the rest of your life. Now, you have to make sure that $1.28 million can last for the rest of your life, but interest rate is zero, right? So you got to learn how to buy stocks. And I think sure as hell you don't have enough money with that $1.28 million to buy a second property. Anyway, prices will run up way ahead after the 10 years. You can't buy anything with 1.28, maybe a car park. So number two, second option, if you do not sell, what happens? Well, the investment property might be cash flow positive by then, right? Because mortgage payment is the same, but the rents is adjusted by inflation. So yeah, you get some income. Maybe you use that to pay off the mortgage of the one that you live in. But what do you live on? You have no cash, right? So that's the problem of two in Singapore. As I said repeatedly, you need more than two properties to retire on. Okay, you need about 4 to 5. Now, in Singapore, there is also a problem of affordability. I know that landed property prices have gone through the roof, and I think that the ship has sailed. A median landed property costs 3.85 million in 2021. Okay, the average price is $5 million, right? The per square foot is $1,462 per square foot. Okay, a condo is 1,731. Okay, the median price of a condo is 1.468 million. So definitely the gap has almost closed. The discount is very faint, like 10% max or sometimes zero on a per square foot basis. And the ratio of house price to apartment is 2.84 times now. So it's definitely a huge leap from apartments to jump to landed. So what happens when you need new space, given that the average condo size is only 1,053 square feet, right? Once you hit about 1,700 square feet, or you want a bigger house that's over that size, you might want to look at landed, but you're stuck. And so where do the investment opportunity lies? As I repeatedly mentioned before, there are many countries in the West, in the developed world, where the rule of law is strong, where the house price to apartment ratio is very reasonable. It's 1.4 times. Okay, it's just like Singapore in the 1990s, where nobody talks about owning a landed as a status symbol. Okay, the average semi-detached in Birmingham, for example, is £226,000. Okay, the average flat price is £159,000. So the ratio is 1.4. I have no doubt that, on a per square foot basis, okay, it might be for a semi-detached is only in Birmingham £200 per square foot to 220, whereas a new apartment is about 400. It's almost half, a 50% discount. This gap will no doubt close. So think, where the ship has sailed in Singapore, it has not sailed in many countries, the US, the UK, New Zealand, where the ratios are still there. Okay, it's still 1.4 times. And you will outperform for many years to come. And also, have you ever thought about buying a Porsche or a Ferrari in Singapore? It's just ridiculous, doesn't make sense, right? I mean, the government taxes you heaps, and a car costs 3 times more in Singapore. So a Ferrari is $1 million Sing dollars, whereas for in UK probably can buy it for about £100,000, okay, or £120,000. That is close to about 250,000 Sing. Okay, it is the dollar that you spend in Singapore. It is really very little that you can get. Same thing as a landed property, right? In Singapore, I mean, no disrespect to people who own landed properties, is whatever land has been maximized, and it's like a huge condo that's tailor-made to your taste, right? There's no garden because the weather is hot. I understand. Okay, but in temperate countries, a garden is really nice where kids can go out there and kick a football, play cricket. You could host a party there, and it's only 15 degrees. Cool, right? And there's a real garden, and the built-in might be only 3,000 to 2,000 square feet. You don't build it up like a condo complex. So that is really landed living. And think about what your money can stretch to, and the capital appreciation part, and also that the price is so low, the rental yield is so high. It is probably about 5 to 7% rental yield net if you rent it out, whereas the mortgage rate is only about 3%. So let me share with you a little bit about my property journey from 1999 to 2021, right? I started out trading properties, buy, sell, right? Every 3-4 years, I buy it and I sell it. Yeah, that's well and good. I thought about doing this for the long term, but I realized that the transaction cost is very high. Each round trip is about 5 to 6%, right? So if you want to buy and sell a property over that 3 to 4 years, okay, you better make sure that your returns are about 15 to 20% over that 3 years. That is a huge 6 to 7% return, because transaction cost takes out 6%, right? If you make 15%, you're left with only 9%. And that is not a great result, right? It's very costly to trade. So in 2013, I embarked on the B4R strategy, where I buy houses and buy things that are rare, refurb to raise the value, rent, and then remortgage at the higher value to take out all my cash to repeat again, and I never sell. My exit strategy for B4R strategy is death. Okay, that is the most tax efficient, because when you remortgage, you do not pay stamp duties. So, you know, within 8 years, I built up a portfolio of over 10 properties. And, you know, my strategy has always been 10 properties in 10 years. And after that, what do? Well, after you reach a 10th year journey, you realize that, hey, the first few properties that you bought has already gone up or doubled in value or tripled, you know, in some cases. So you start selling those with the least upside, or that gives you the most problems. And because even though it might give you problems, after 10 years, they have given you about a nice 50 to 100% return or more. You could realize about $300,000 to $400,000 of cap proceeds a year. Now, with that money, you do not put it all back into properties. So let's say you have $400,000 of proceeds. You take half to put into stocks and half to put back into property. So your financial assets start to rise as you get wealthier, and then the property assets rise slower, whereas your financial assets rise faster, so that you get liquidity. Okay, so that is the game plan for B4R property and 10 properties in 10 years. So in summary, right, 2 properties are definitely not enough to be financially free in 10 years. Okay, number 2, you can be financially free by investing in countries where B4R is allowed. Number 3, borrowing to buy a house with negative cash flow is very dangerous. Don't aspire and stretch beyond your means and just go for that $3.8 million landed property and put in $1.8 million of your hard-earned savings as a deposit and borrow $2 million of mortgage, and then you have $10,000 of mortgage to pay a month. And I tell you, your family will be so stressed, you have no guts to leave your job and live life of your dreams. You're stuck in a job that you hate. So that will be the worst thing, right? Unless you love your job, then continue to work until you're 80, I hope. So number 4, you need to choose properties with a strong chance of capital appreciation, and you need positive cash flow when you leverage. How many countries can do that? I think Singapore has already missed the boat, because if it's negative cash flow, the more you buy, the more negative your cash flow is, and then you are again stuck in your job, which you may not like. Number 5, buy what's rare. Okay, buy houses in overseas market, be open-minded, do some research, get mentors. Okay, where the house price to apartment ratios are still below 1.5, because eventually, okay, they are behind. Look, imagine a time machine, they are behind, about 20 years behind Singapore. So eventually they'll outperform. So already we know that, take for example, my Brisbane townhouse. Okay, during COVID 2020, it was about 350,000. Just before COVID, suddenly it shot up to 600,000, over $600,000. That's close to 40% appreciation in 1.5 years. Okay, and the terraces in corner terraces in Birmingham has gone up by 20% over that 1.5 years. So I have no doubt that if you buy whatever has a piece of land, and I don't like flats, that's my personal opinion, right? There's a whole kettle of problems, but houses and buy what's rare, sitting on a big piece of land with garden is affordable, they will outperform in many years later. So if you find this video useful to you, please like and subscribe. And if you want to find out more, attend my webinar. Okay, there'll be a free webinar every few weeks. So I will see you there.